Ladies and gentlemen, really excited about this episode. Welcome to the 18th ever episode of the Failing to Success in Multifamily show, a podcast where we appreciate, discuss, and reflect on the setbacks real estate investors have had leading up to their success. Today, I have the absolute privilege and honor to have William Edwards on as a guest. I got introduced to Will through a mutual connection and fellow rockstar multifamily investor, Charles Seaman. As a matter of fact, both Will and Charles host a actually one of the few multifamily meetups in Charlotte where they provide a ton of value. Link in the show notes for the next event. Will and I connected, and his background really impressed me. Okay. From how he got his first multifamily deal as a main operator to how he was able to scale up from there. Will currently owns 188 units as a GP and KP, and over 5,000 units as an LP. And I can't wait for you all to hear his journey, his successes, but most of all, and the reason why we are here today, his failures as he continues to reach his goals within multifamily. Will, welcome to the show, my friend.
Hey, thank you for having me. I enjoyed it. I appreciate it.
Yes. Now, Will, I think I did a fairly bad job at introducing you, so please let us know who William is.
Well, in regards to multifamily, my journey is probably not typical. Although everybody's different and they have their own pathway, right? But I've not been in real estate or multifamily real estate specifically my whole career, right? So I started a business with a business partner that we sold business management software systems. So we sold and serviced ERP, enterprise resource planning, customer relationship management, and then ancillary products or modules that go along with that, primarily around the distribution and manufacturing spaces, right? So had that business for 24 years, sold it in 2015. That really wasn't enough to retire at that point, right? So I continued to work, went to work doing project management in the same space, actually for a friendly competitor, but doing project management for installation and implementation support of ERP software systems. And did that for a while from 2015 to 2019. Made a transition over to project management also for the implementation of ERP software systems in a large corporate industrial conglomerate company, right? So I did ERP software implementation project management and also some M&A from the IT side, M&A projects. So, but after I sold the business, and my business partner and I sold that business, I started really starting to think about what's the roadmap going to look like, right? So I've kind of had a full career in business. We had built well. There was one point in there that we did do something around real estate. We actually built our own office building.
Mm.
Built that, leased it, formed a different company, built it, and did the development from that. Did a triple net lease back to ourselves. So when we sold the business, we still had that property. Continued to sell that to the buyer, and not sell it, but continued to rent that to the buyer. They eventually relocated the business to another community. We sold that property at that point. But other than that, in my own primary residence, that's all I'd really done around real estate. But what I'm leading up to is I started to, I'm getting, everybody's in a different season of life, and I'm a little bit older, and not ready to retire yet, but when's it going to come, and what's it going to look like? And I remembered, am old enough to remember, the Black Friday or Monday event back in, the 1990 era. I remember Y2K, the recession that the crash that we had in 2008, 9, 10, that era. And of course, nobody could have predicted COVID, and COVID wasn't here yet. But it seems, I really started to think that about every 10 years, there's a major economic event that happens to us, right? And I had some more senior, mature friends in that 2008, 9 era that had shared with me that during that period of time, they were retired and they had a lot of their retirement savings in stocks and equities. And that they had lost about half of their life savings during that period of time. and weren't sure how long it was going to take for that to come back, or if it would come back, or if they would survive long enough for it to come back.
Mm.
Depending how old they were. But it started me to thinking, right? And so just like everybody else, I had, started an IRA here. I had a 401k. We had a simple IRA at the office. My wife had similar things. We kind of had a sock drawer of qualified retirement plans. Um, so what I started doing, my wife jokes that she lost me for about 6 to 9 months because I just got totally immersed in, what are we going to do to plan for and build a base of for us to be able to retire. And I didn't want it to be in equities, but I didn't know what else to do. Right. So I started educating myself, and I was reading massive amounts of books. I was watching YouTube videos. I was watching and listening to podcasts and video casts
Mhm.
and vlogs and blogs and everything. So after work, I was in dinner with the family. That was my job, right? It was to learn about things. So I really started zeroing in on where, for me, what did I need and what did our family need, and real estate checked a lot of those boxes, and I got pretty serious about looking at some single family um, rentals, and was going to buy single family rentals, and my gut was just telling me that's not the right thing to do. I felt like I was going to be buying a job because I was going to have X number. They weren't all going to be side by side, just because that's the way things work, right? You have to buy what you can buy wherever it is, and it could even be in different communities. I didn't want to be a landlord. I didn't want to buy another job. Although from a returns, a leverage, is real, right? Cash flowing assets, it checked those boxes, but I didn't want to be a property manager, and I didn't want to have properties all over the place. I looked kind of seriously at commercial office. I came close to putting in an LOI. An LOI, for those who are new to the space, is what's called a letter of intent. It's right, here's my offer to buy. So you find a property, you evaluate it, you do your own underwriting on it, and you figure, based on the numbers and the rents and the expense ratios and those kinds of things, here's what I think the property is worth and what I would be willing to buy it for in your terms, right? I'm going to buy it at this. My offer is I'm going to buy it at this. I need this kind of term, for example, 30 days for due diligence. Here's how much I'm willing to put down as earnest money. I expect to close in 60 days, 90 days. If there are any contingencies in there, if you have a finance contingency or some other contingencies, what are those? But LOI is letter of intent. So, this industry, just like most industries, it has its own language, and there's a lot of acronyms that get thrown around. So I try to be cognizant of that, and when I'm sharing with people who may not be in the space, try to help them follow along, right?
Much
So
appreciated.
if I don't do that and I'm start throwing around some terms, catch me and reel me back
Absolutely.
in.
Or I'll
But
try, right?
I got close to putting an LI on office space. I didn't do that. I came actually to office spaces. I looked at a very high level at self storage, uh, and I just didn't feel like it didn't feel great, and I felt like I was going to have employees, and I wasn't sure about that for me as an operator. Now it turns out at this point I'm actually an investor as a limited partner. LP, it stands for limited partner, in some self storage businesses, but I'm not the sponsor or the operator of those. I'm an investor in those. I looked at some triple net lease type deals. So if you think of McDonald's or Walgreens and those types of businesses, they may not necessarily own the building and the property. Somebody else owns it, develops it, leases it to them, or they may develop it and sell it and do a lease back, arrangement. But I looked at some of those. But the thing that just kept checking the most boxes for me was multifamily. And so I got really interested in multifamily. So although this net was wide when I got started, it just started. The more I learned and understood and evaluated that against what my needs and requirements were, multifamily checked the most boxes. So I got really interested in that. So in 2018, I started investing in as a limited partner, as an investor in some other people's deals, and I did that through my 401k. So the traditional 401ks that we have with Fidelity or Schwab or any of the other custodians, the common custodians, right? they have a portfolio of products you're allowed to invest in, and it's usually, if it's a corporate sponsored deal, maybe corporate stock, ETFs, mutual funds, stocks, bonds. But there's a portfolio of things you can do where you're actually allowed to invest in more product types than that. And if you have a custodian or you set up a self-directed IRA, those will allow you to, and they're also called solo Ks or solo 401ks, allow you to invest in some other asset types, right? So real estate is one, gold, some of the things like that you can do. It's a broader mix of products that the government allows you to invest in, than what the typical custodians will offer to you or make available to you. So I consolidated some of my qualified plans into a solo 401k. My wife did the same thing. We started investing as limited partners, and I wanted to learn the space, right? So I wanted to learn how do people operate deals. What do the deals look like? What kind of reporting do you get? How do they manage a deal? And so you don't get, you're not standing shoulder to shoulder as a general partner or a GP with them, but you do get some exposure, and then you develop a relationship. And as it turns out now, over the years, and I'm in multiple deals with some of those same operators. So as deals have gone full cycle or produced enough cash flow, and that was another thing for us that was important, was cash flow, because when you're investing in real estate, it's not a liquid investment like stocks. You can't call up TD Ameritrade and say, hey, I want out of this deal tomorrow. I want to sell this position in this stock, and I want to move it over into this ETF. Typically, deals, if they're syndicated deals, joint ventures are different, solo deals are different. But if you're investing in a syndicated deal, as a limited partner with somebody else who's operating and running the deal, there's a business plan, and that business plan is typically 3, 5, 7, 10 years. And it may involve a value add. If it's a lower class property, they may need to renovate it to get rents up. It could be what's called a core play, where it's really just you're running the deal and going to organically raise rents as the economy allows you to raise rents. But we needed cash flow, and so we were looking for deals that were going to cash flow. But I started that process, and so now, like I said, I'm in multiple deals with some of the same operators. I look at more deals than I'm able to invest in, because I want to know what's going on in the market. What are these operators? And there's a handful of operators that I would want to do deals with. If it's a timing issue. So even if it's an operator that I'm already invested with, and they sell a deal, and they sell a deal, and I've got some cash, then I've got some liquidity, right? I can go invest in their next deal if it's one that I like, or in somebody else's deal.
Yeah.
Or if deals over the years have thrown off enough cash flow each month or quarter, depending on how their distributions are paid, that builds up a cash balance, and then I've got enough that I can go, do a lump investment in another deal.
Makes sense.
And so I look at more deals and I'm able to get in. And that's one of the things that people need to think about. You may be super interested in and like an operator, and you may like the deals that they bring to the table, but do they have a deal when you're liquid? And are you liquid when they have a deal, right? It's a timing issue. So for those guys that are doing syndicated deals, they may have a large network of potential investors that may want to do a deal, but it's also, is it the right deal for them at the right time? Are they liquid when they have the deal? And do they like that particular deal in that particular market, right? So some people specialize in certain markets. Some, have an affinity for other markets, or an aversion to certain markets, right? So anyway, long story short, I started doing limited partner investments in 2018. And in 2019, I found a deal, my first deal that I was gonna own and operate. It was a 37 unit, and it was townhome format. So it's 5 buildings, but they're all 950 square feet, 2 bed, 2.5 bath. And so I did that on my own. So my wife and I did that with our personal funds, not in our retirement funds. And that's a catch. I'll just go ahead and advise everybody. So you can do self-directed IRAs, you can do solo 401ks. There are some restrictions on those. So you can invest in real estate, but you can't invest in your own deals. So it's called self-dealing, and there's a catch there, right? You can't do that, but they're ideal and perfect for investing in other people's deals. So if you want a joint venture, there's some requirements about how much ownership and control you have, whether you're signing on the loan, that kind of stuff. But as a limited partner investment, it's ideal, and that's what we've done, and we've continued to do that. So most all of our limited partner investments are through our qualified retirement plans, and then our personal investments are funding the stuff that we're in right now, that 188 units. So I had that property and that 37 unit and had it we bought that with the intent, it was a 2012 vintage, that we're going to hold it a while, at least 10 years, if not more. And had no intentions of selling it. And then for those who've been monitoring what's been going on in the market the last couple of years, it's gotten really um, crazy.
Yeah.
It's definitely been a seller's market, right? So prices have elevated. What we call cap rates or capitalization rates, which is a factor for determining the value of a product in a particular market or submarket, have been compressed, which increases the effective rate. And interest rates were low, so people could afford to buy more. And now that rates are going up, that's an issue. They have to buy less because they've got a debt service, and the debt service is more expensive, and that's part of their expenses, right? So we got a great rate at the time. We refinanced it while we held it. We lowered the rate a couple points. We were able to successfully challenge the tax valuation on it and get a break on the tax valuation. We operated it well. Now we had some challenges initially on, and I'll certainly be glad to talk through those, because those are some of my failures, some lessons learned, right? Life lessons.
Absolutely.
But we sold that in 2021. And we started getting unsolicited offers. We had not planned to sell it. In fact, we turned away the first couple of phone calls we got. It's like, yeah, yes, we own that property, but it's a long-term hold. It's doing well. We're good. We're not going to do anything. And then a broker, and it was a good strategy. It was a broker I'd not talked to before and didn't have a relationship with. And I said, but send me your contact info. I'd like to keep you in my CRM, and let's stay in touch, right? I may be in the market, or at some point we want to sell and we want to have a conversation. Well, he sent me an LOI, a letter of intent from his buyer, along with that, and it was at a number that really got our attention. And so we started having some conversations, and eventually did sell. So we sold that. We kept it 30 months, and it was almost a 3x equity multiple. So it was a home run, and they will not all be that way. It was 2.9, but if you round up, it was a 3.
That's amazing.
But it was a fantastic deal. But I've since rolled those into other deals. We did 1031 exchanges into some other deals with some other partners. And so I've got an 84 unit and a 72 unit. And then outside of that 1031 exchange, for those viewers who aren't familiar, that's a way to tax defer proceeds from the sale of real estate, real property, into another property. And without having to pay the taxes now, you can roll those into that one. And then at some point it'll come due, or if it's eventually bequeathed in your estate to your kids, then those that inherit it will actually get what's called a step up in basis. So they effectively get it tax free if they decide to sell at that point, or they can continue to operate it, and then they will have a tax liability based on any appreciation at that point. But so if you want to create generational wealth, that's another thing that real estate offers us, guys, is the ability to create generational wealth, not just for your current immediate family, but for generations to come, if you do it right, if you plan.
Absolutely.
But so, and then with another set of partners, in June, we closed on a 32 unit in June. That's a value add play. It's a Class C deal that we're in the process of getting renovations going on that. So that's going to be one of those types of deals where you have to do the renovations and increase rents and that kind of thing.
Not too long ago.
That was just a couple months ago. Yeah.
Nice. That's
That
awesome.
one's fresh.
Sounds like it. Man, Will, a lot to unpack here. I mean, you have an amazing story. First of all, starting out from your entrepreneurial and business owner background, right? I'm sure that was a challenge and a great journey on its own, but you came to the realization after selling your business successfully, which not a lot of people get to. You sold your business, but then you realized what's next, right? How do I preserve and continue growing this wealth, this hard work that I've built over the past years? And you decided to get into real estate, right? You looked at different ways, different strategies that you wanted to get into real estate, um, and you ended up settling in um, multifamily, right? Um,
Right.
and
Right.
you know that's as you mentioned, multifamily or real estate as an investment vehicle is it's one of the best wealth retainers out there, right? Um,
It's super tax advantaged. I mean, that's huge, right? So we have, people may have heard of depreciation, but there's this concept of bonus depreciation or accelerated depreciation that we've been able to take advantage of for the last some number of years. This it's just it's amazing, right? So even though you may have a cash flowing property that is cash flow positive, right? um, After depreciation, which is a paper loss, right? You end up with a paper tax loss on it. And depending on how large that is, that can be deferred to subsequent years, so it can actually carry forward for a couple number of years,
yeah,
and cover any other cash flow or you know taxes that may have come due, and it'll more than offset those for a good while. And if you look at one of the books that I read, and I can't remember the name of the book, but I've heard multiple times that the tax code, if you were to evaluate it, and I don't remember what the ratio is, but it's about 10% of what you owe taxes on, and then the other 90% are the exceptions, and it's things that Congress does to encourage home ownership,
hmm
encourage investments. Multifamily is providing homes for people, right? People have to have places to live, and they always will, and that's something else that's attractive about multifamily versus offices. And as we've seen during COVID, people don't have to have an office. As we're doing right now, we're doing a virtual conversation and a virtual meeting. That's totally changed in our society and our economy.
yeah,
With very fast in just a number of years.
yeah,
So a lot of office products are having challenges, but people still have to live, right? They have to have a roof over the head, and we're providing a service to society. And whether people are buying single family homes, or they're renting a single family home, or they're renting multifamily, um, they still need housing, right? And so it's a service, and it's encouraged by the Congresses over the years, to encourage investment and development, and we still are at an extreme shortage of housing right now. And it's going to be for a while. I just don't think built the builders can build our way out of this in any kind of short term.
yeah.
Um, it's a challenge for our economy. It's a challenge for our society right now.
Absolutely, absolutely. Yeah, and the I read a crazy stat, that evaluated the amount of homes that we need to build each year just to catch up to the housing demand, and statistically, it's almost impossible to do that,
Yeah,
especially given the cost to build and things like that. But I want to dive back into your story and the strategy that you took to actually get started, which is pretty interesting. And you actually went into uh, the real estate world as an LP to test out the waters and to also network with operators that were doing what you eventually wanted to do. And it's a great strategy. But what I would like to find out is that process, right? At what point did you feel comfortable to actually take on that 34 or 37 units that you ended up taking on by yourself? At what point did you gather enough knowledge um, and confidence to really go into it as the main operator? And how did that look like?
yeah. And as it turns out, I didn't realize it at the time, but I was very fortunate in that and I haven't shared this piece with many people, but that was actually the first LOI that I ever wrote, and I got the deal.
No kidding.
But I will tell you, it's not the first. I looked at that deal a number of times, and it let it pass, right? So I started doing LP investments, creating relationships, learning about the space, and I had been doing that for 6 or 9 months, just learning about getting educated, right?
Yep.
Um, if you want to be a sponsor, or an operator, you need to know you need to be comfortable in that and understand it. But in the meantime, I was looking at, in developing relationships with brokers, getting on mailing lists. I was looking at LoopNet, which is a service that I think CoStar owns it now, but it's a service of, we can look, for example, for multifamily homes,
Mhm.
properties, land, that's available in the commercial space. And this property I had seen, and the numbers just didn't seem to make sense. And so I just passed on. I like the look of it. I like the location. I like the count. It was actually more. I really thought all that we were going to be able to afford. was going to be probably 20, 24 units. And so this was going to be a stretch. It was going to take more than what we had planned to do as our first deal. And we all do the best we can do with what we've got, right? So if I'd had less funds available and had not sold the business, I'd have probably started out, with a 4, 6, 8 unit and then stepped up from there. You do the best you can do with what you got, right? So I was fortunate in that regard. I had some cash from selling the business that I had been sitting on the sidelines in stocks that I could invest. But I'd passed on this property a couple of times, and then I kept coming back to it. And it was on LoopNet, by the way, so it was a LoopNet deal. And
Which
what I
is
was
not
able
a
to
lot of
figure
people
out
know.
was, I'm
Mhm.
sorry.
Yeah, just going to point something out real quick is a lot of people see LoopNet as a place where deal go and die, right? It's a place where numbers don't make sense and things are overpriced. But you were actually able to find what turned out to be an amazing deal on that platform.
It was, and I didn't know it the first time or two that I looked at it. But the expense ratios seem high, and it's like I don't understand why it's high, but the numbers don't work, right? I would need a better expense, a lower amount of expenses, and some higher revenue to be able to make things happen. What I was eventually able to figure out was the owners of that property also owned another property literally around the corner that was like a 120 unit deal.
Mhm.
And they were operating, and 37 units, you can't afford to have on site property management. So it's going to have to be off site management. So they were managing and operating this property out of the leasing office, and they were handling leasing out of this other property, and they were sharing maintenance teams from that property to service this property and all that. But they were doing some allocations of expenses, and they were actually over allocating the expenses to this property, which made this one not
Oh,
look so great. Um, but what I was like, why are these expenses high? I'm looking at a lot of deals, trying to find something, and this ratio, I just, and that this isn't going to be exact, but other expense ratios may have been, 43, 44, 45% expense ratio, and this one was a little bit over 50. It's like, why is it so high?
hmm,
But it's high. That's what it is. Pass, right? But I
hmm,
just kept coming back to it and started really thinking about it. And the more questions I asked, I learned more. It's like, you know what? I think I could operate this
yeah,
more efficiently than the current ownership group is able to. If I
interesting.
did this, I could do this better. If I did that, I could do this better. I could cut here. I think we could raise rents a bit. We could, you know, that kind of stuff. And so I did my own pro forma of what my projections are of how this property could operate. Um, share that with a banker. Y'all, I shared it with the broker. Here's what I think and what my reasoning is. Y'all look over my shoulder. I can't afford to make a mistake on this first deal. So I want all the eyeballs on this that I can get.
Love it.
And everybody's like, yeah, what you're saying is sound, right? And some of that could have been from my business background and understanding and being comfortable that I could manage, some of that transition. Um, some of the things that we didn't understand, that I didn't understand and appreciate when we took over the property was, we do due diligence, and that's part of every property. And what that means for those that aren't in space or aren't in space yet is you actually go in and you're verifying and validating what the current ownership is telling you. Yeah, these are the rent rolls, these are the leases. You're doing that a lease audit, right? Do you have a lease for every unit? Are the rents currently accurately reflected? Have they done credit checks? Have they done, you know, employment verification, salary verification, that kind of stuff. Some things that I and you're doing a physical visit of the property. This is 37 units across 5 buildings, and during our due diligence, we sampled units. So we sampled, 1 or 2 units in each building, but we didn't hit them all. And I didn't bring in an HVAC expert
Mm,
or technician to look at the HVAC unit. So after we took over the property, one of the things that we learned was we probably should have looked at more units. And the previous ownership group, I think, to try to probably keep the property operating and the financials looking as good as possible, they weren't replacing things that might need replacing, and they were just kind of keeping things going. So, for example, there was an upstairs and a downstairs in these townhomes, and there was a zone control board. And in several units, we learned later, once we started having HVAC calls, that the previous techs disabled the board and just cross-wired it so that one thermostat controlled both. So they basically took the multi-zone
Mm-hmm.
feature away, and that kind of stuff. If there were leaks and then some of the coolant leaks, they would just replace it. They wouldn't replace the coolant; they would reload the coolant. They wouldn't fix the problem. And so as we got, we bought it, and then we started hitting summer months, and we had to replace more than we expected. And that was it's like, man, if we got to replace all these things, it's only 2012. We bought it in 19.
Oh,
These things shouldn't be failing this bad,
this early.
to the point where we're having to replace this number of units. So one of the lessons I learned is walk all the units, right? Even if you have to bring in extra help to do it and you're not doing it yourself. I tried to do it myself. I did hire a GC to come in, and I walked the same units that he walked, but it was a sampling. It wasn't all. Bring in an HVAC tech, have the HVAC tech look at the units, give you an opinion of that. Get a plumber, electrician. I actually had a home inspector that was able to do several of those, in one visit, um, and make sure that you don't have any issues. But walk all the units, and then understand that. And then one of the other things that I saw on the rent rolls and in the leases, but I didn't really appreciate, was that a lot of the tenants had either $0 security deposits. They hadn't charged them one, and that was a promotion. The way they explained it to us,
Mm-hmm.
that was a promotional deal that we offered at one time. So those tenants came in under that promo where they had a $99 security deposit. Invariably, those were the tenants we had problems with. That they were either tight on funds, didn't want to pay, whatever. And it took us a while, a little less than a year, but about, a little less to a year maybe to work through those. So as those tenants left and we replaced them, and we were asking for at least a month security deposit, we wanted to make sure that we had at least, um, 3 times, income to rent. Some of the previous tenants didn't have that ratio, so these were stronger tenants who were more capable of paying, and that wasn't going to be a challenge for them. And things settled out. I mean, if we had a graph, it was linear, right? So as we replaced those units, the HVAC stuff, and the tenants through attrition, we weren't evicting anybody. Left, and we replaced them, and the ones that stayed, we still had, I think, 3 or 4 by the time we sold it, still at 30 months, because I tracked it, that had come in under that promo of either 0 or $99 security deposit. And they were great tenants, right? So, maybe they were exceptions, or they learned that we weren't going to operate the property the same way. But it ended up working out well.
That's awesome. That is amazing. That is amazing.
And something else that I'll share with you is that, taking care of the tenants means a lot. They appreciate it. They see it. We did get comments back, and my wife and I, our perspective, we didn't manage the property ourselves. We hired a third-party property management company. It was all site. Again, 37 units. You can't really justify taking a unit out of service
Yeah.
to make it a leasing office.
For management.
It was off-site management, but they had the same approach, and we made sure, because we interviewed a number of groups. We want to do the right thing, and we're going to take care of people. We're going to provide them a nice place to live, but in exchange for that, they have some obligations and duties too.
Yeah.
Rent's due by the 5th. You got to take care of your property. You can't junk up the place. We've got our. It's a partnership, right? We both have to do our part. But what I was going to say was, during COVID, because we had I think already started to set a track record. We virtually maintained 100% occupancy during the COVID while we owned and operated the property.
That's
We were actually raising rents during that period of time,
really
and didn't have to do any evictions. So now we had some normal turnover. So the unit was down, 2-3 weeks while we were getting carpets cleaned, repainted, marketing the property, evaluating applicants and that kind of stuff. So
actually raised.
normal turnover, but outside of normal turnover for units for people that were transitioning out, we were virtually 100% occupied. So that was great.
That's impressive. That a lot of people were lowering rents and feeling shaky,
Right.
but you were actually raising the rents. And that's
And
impressive.
with what's going on in the market today, and we don't know when people will see this podcast, but today, if you're looking at it historically,
Mhm.
we're in a period of time where interest rates are up, prices are coming down, people are starting. It's been a while in our space where people have had to offer a lot of concessions to get tenants in the building, right? But I remember 15 years ago, I could drive down the roadway and I remember seeing banners, free month's rent for new renters, or free plasma. At the time, plasma was a hot big deal, right? Free plasma screen TV, with new rent. Um, we haven't seen those yet, but things aren't always good. Nothing ever stays the same, good or bad, right? And we've had a good run, but the smart business people are gonna probably be the ones that'll be a little bit more successful.
Yeah.
There've been a lot of people, and I was a beneficiary of lower cap rates and zero interest rates and all that. When we sold the property. If we were selling it a year or 2 years later, we probably would not have been able to get the same number for it. But we'd done a good job. We did it. We operated it well, and it paid off.
Yeah. Man, such great lessons that you're providing our audience here. And frankly, one of the sentences that resonates with me the most as you're sharing your story, your lessons, and the progress that you've made so far is, perfection is the enemy of progress. And the reason why I say that, Will, is because, um, you know, you had gathered a lot of experience and a lot of knowledge before getting into your first deal, and I'm sure that you were well equipped to go in. You were very confident, and there were still some aspects that you overlooked. You mentioned that you didn't look um, at all of the units, right? So you didn't necessarily need to have all of your questions answered before closing on this deal, right? You had the right metrics to make a very educated decision. Yes, things came up, but it turned out to be an amazing deal. I mean, 2.9 equity multiple, that's insane, right? And
Yeah.
that's one of the takeaways here. You don't need to know everything ahead of time,
Right.
you
Right.
know and you can still.
And ask and leverage people who do, right? Get people to look over your shoulder. Get the banker to look over your shoulder. Get the broker to look over your shoulder. It's like, dude, this is a big deal for me. This is a big first step. I've never done this before. I don't want to goof it up really bad. I might not operate at 100% or as well as maybe somebody who is a little more experienced, but I don't want to. And I have an obligation and a duty to the tenants, right? To take care of the place, make sure they're taken care of. I need to do this right, but don't be afraid to ask people that are in the space, people like you, me, who are doing this, right? What do you think? And that is something that I've learned over the years, and I've joined several mentorship programs that I'm involved in. People are really generous with their time and their willingness to help and check things out for you, right? So it's a relationship business. It's a
Awesome.
relationship business.
Love that. Thank you so much for pointing that out. This brings us to the third segment of our podcast, which is mindset, right? Well, so far you have shown me that you are an action taker and you're not afraid to jump in. You're not afraid to jump in. You analyze things well, and then you jump in when it makes sense. And I love that about you. I want to know, there were some unexpected challenges that you had to overcome within this deal. So how did you keep yourself motivated to get through those challenges?
Yeah, and so and that's whether you're doing and whether you're doing any kind of business, right? Or whether you're on a team, you're a member of the staff, or you're an executive or an owner or an entrepreneur, it doesn't matter, right? In business, nothing ever stays the same. Uh, it better not, or you won't be around very long, right?
Yeah.
You need to get comfortable with being uncomfortable. And um, somebody told me one time, and it's a common quote, but it's very relevant. If you don't like change, you're going to like being irrelevant a whole lot less. You know, it's things are going to change, but you have to be able to adapt, right? And you don't know what's going to happen, right, from one day to the next. And admittedly, this was a big step for us and our family, that first deal. And I had some restless nights, insomnia, whatever you want to call it. Did we do the right thing? And um, it turns out we did, but there was some anxiety, right? There's going to be. It's a big step,
Yeah.
but you have to get comfortable with being uncomfortable and be confident in yourself that either you can solve the problem or you can bring in someone that can help you solve the problem.
Mhm.
Work as a team, right?
Yeah.
But to your point of what keeps me motivated, what kept me motivated during that period of time was um, I wanted to make sure that I was doing the right thing for our family and I was doing the right thing for the tenants, right?
Love that.
Um, and so there were periods of time where we would get tenant requests through the property management company. I made sure that we had weekly meetings with the property management company, and we communicated all day, not every day. That's not a fair statement. A couple times a week, we would have emails or texts if something came up. But we always had, and our meetings were on Thursday afternoons, right? So every Thursday afternoon at X amount of time in the afternoon, we had a standing call with the property management company. We went over the rent rolls, the maintenance logs, any of the issues that have come up, any collection issues that we have. If we have to look at doing evictions or filing on people, what are those? But we would have tenant requests, and a lot of times, my wife and I would make decisions like, it's not something we would normally do, but they're a good tenant. They pay every month. They don't give us any grief. They take care of that unit, right? So whenever we do, or the property manager would do inspections, or whether we'd have to go in for service or whatever, they're taking care of the unit. I'm willing to give a few things, and sometimes we couldn't or wouldn't, and it just didn't make any sense. But just trust yourself that you're gonna do the right thing by the tenants and for the property and operate it. And this is another point I'm going to make. A lot of these real estate can be expensive, right? And whether it's a fourplex or a duplex, scaling up from there, depending what class it is. And for those who again aren't familiar with the space, we typically think of properties in like an ABCD class, right? Class A are typically newer properties that are swimming pools, jacuzzis. They might have a private kitchen in the clubhouse. They've got workout rooms. They've got putting greens. They've got maybe a golf driving range. The virtual golf driving range. They've got they're A-class properties, right? They're the more expensive. They're newer properties. B is kind of a step below. It may not have some of the amenities. It might not have a pool. It's certainly not going to have the driving range. It might not even have a clubhouse, right? It might be a place where people live, right? It's buildings of apartments, but they're decent, nice apartments that are well taken care of, and this is their home, right? Class C in a lot of cases are typically older. They might have need some work. They might need some TLC, some tender living care, right? And they might not have been renovated in a while. And you're not going to renovate a Class C property. And a lot of this also is what area of the market or submarket they're placed in, right? In a downtown Charlotte, North Carolina, for example, that's going to be a different amenity and class of product than one that's in an urban area, for example, or maybe one of the surrounding communities around Charlotte. Class C's might need some value add, right? They might need some TLC. You're not going to put granite countertops in, but you may, place the carpet and put in, LVP or laminated vinyl plank. You might put in, stainless steel appliances. You might put in, subway tile backsplashes, that kind of stuff, to make it, a more update and current property. But you're not going to add a pool. You're not going to do those kinds of things. You probably can't afford to put in package lockers and that kind of stuff. But and then Class D's are kind of the war zone properties that have just been there forever, and nobody's ever taken care of them. Or that submarket has changed. Over the years. 30 years ago, it could have been a very nice place to live, and things have changed. And conversely, through gentrification, it goes the other way too, right? What was typically a C class area in a particular community may over time, it's now a B, right? People are moving in, they're trying to get closer. There's new properties being built, so it goes both ways. But we typically think of things in ABCD class.
Beautiful, beautiful, man. What a wealth of knowledge you are, Will. And I've personally have already, you know, gotten a lot of value out of this conversation, and frankly, a lot of uh, personal mental notes that I'm taking, for myself, especially when it comes to your own personal lessons that you've learned in that first deal. So thank you so much for sharing that. I'm sure that our audience is also going to get tremendous value out of it for themselves.
Certainly.
Um,
Absolutely.
Now, I want to get into the final segment of this show, and that is to find out your goals and what you're currently working on for the rest of this year. I know that off camera you were mentioning that you you had one deal that you recently closed in June that you're planning on taking on. But what else do you currently have on site as we head into the third quarter and fourth quarter of 2022?
Yeah, so and kind of my philosophy is I want to be deliberate in what I'm doing, right, and diligent in what I'm doing. And with the current state of the market, it's been really a seller's market. It's been overpriced. Numbers haven't made sense, and compound that now with our rising interest rates because of inflation. Our inflation now is, for those that are looking back at this later, is we're at 9-10% inflation in the current months. I think last month it might have dropped down to 8.9 or something, but it's high, right? And it has been high for a while, and it's forecasted to continue. The Fed is continuing to raise interest rates. They just did a 75 basis point bump in interest rates. It's projected they're going to do that again next month. This is
Very
August, yeah,
soon.
next month. It's going to happen, right? And there may be more to come after that. So, which makes it more expensive to buy everything. Single family homes, if you're buying something on consumer credit, those rates are increasing.
Yeah.
Automobile loans are increasing. Like loans to buy real estate, whether it's raw land or primary residence or an investment property, is more the rates are more expensive, which affects your ability to buy properties. So where I'm going with all that is that I'm not as I'm looking at deals. um I'm not seeing anything that's really made me want to go write an LOI lately. um I'm okay sitting on the sidelines. I'm not out of the game. I'm still looking at things. People will still call me. We'll have conversations. I'll help people do due diligence on deals. Um, I'm still involved, but I'm not committed that I'm going to buy anything again this year. If I find a great deal and it works, then we would. But if it doesn't, then that's okay too. But my goals are, um, so I was fortunate enough that last year I was able to leave the W-2 workspace because of the cash flow that we now have from investment real estate.
Awesome.
Um, I haven't been able to get my wife out of her W-2 job yet, so that's my next goal, and she reminds me of that often. But it's actually, I have a vision board on my wall. Like, you can't see it from here, but it's retire my wife, and that's my next big goal, is to get her out of her W-2 job.
I love that.
So, but it's cash flow based, right? So some properties are investment value plays that will pay off in 3, 5, 7 years. I want to get paid a little bit along the way, and if there's a payout, a bigger bump at the end, that's great. But I need the cash flow, because right now mine and our family's goal is to replace salary, right? I need to be able to replace her salary with income and cash flow from real estate.
That's awesome.
So the deals that I buy have to be, for me, have to be cash flowing properties. If I were in a different season of life, if I were younger, um, I could I wouldn't need that so much, right? I could afford to invest money and wait, 5, 7 years for a big payday at the end, and just give me a little bit along the way. But we have specific numbers. She's got a salary, we've got insurance, we've got to pay. I've got 2 kids that are high school now, a freshman and a senior. So there may be some college in the future. So, I mean, we're looking at a budget, right? I got this number and I need to replace it with this. And until this happens, we can't. So,
Yeah.
that's for us. That's what we're looking at. We're looking at cash flow deals. And if they don't cash flow, then it's not the right deal for us. And the thing is, those deals trade. They don't sit on the market. They move. They're right for somebody.
Yeah.
It might be a different type of investor. It might be somebody who's doing a 1031 exchange. It might be somebody who's working with a family office group. It could be people who are joint venturing, JV, another term. JV stands for joint venture, where a couple, 3, 4, 5 people go in together and buy a property together. Um, Deals trade, and every deal is right for somebody. But if it's just not right for us, I mean, we have what we need, and if it doesn't fit, don't try to put a square peg in a round hole.
Yeah. I love this. Not only do I love your wife, but I also love the husband and wife partnership here. I think that's super, super amazing. Um, and I also really admire your investing strategy in the next coming months, right? Because you're absolutely correct. Who knows what's going to happen with the market? It's
We don't know.
yeah. I think right now it's the savvy investor is actually um, waiting a little bit in the sidelines, not completely out of the game, but just, waiting to see what's going to happen, because I think a lot of investors who've been in this space that we're in for some time know that deals are coming. Deals are coming just
Right.
based off of where you know,
And go ahead and don't, if you're not at a point where you're ready to invest, you don't feel like you could take one down by yourself. It, I was extremely fortunate that I was able to do that. I still can hardly believe that we did that first deal by ourselves. Every other deal's been with a partner. All of our LPs obviously are with syndication groups that are a group of partners who found a deal and put it together and operate it, right? Um, Go ahead. Don't sit on the sidelines. This would be my advice to people. Start getting educated, read,
exactly.
look at podcasts,
Well said.
create the relationships. Go find meetups in your local market
Mhm.
and go to those meetups, just because you not just because you'll learn, but because you also will create relationships with people.
Yeah.
Involve get if you find somebody who has a mentorship program that you click and connect with, and there are several out there, right? There's probably a lot more than I even know about, but um, consider joining one of those, and the relationships you'll find and build and friendships you'll make. I would just tell you that I
Yeah.
had jury duty last week, but the week before I was in a quandary about something, and I wanted to know what other people's opinions were. Well, I had like 10 people that I was able to pick up the phone that I have now a personal relationship with.
Oh,
And when I bought the first property, I didn't have that, and that would be some advice that I would have. I didn't have that, what I'm calling a support system.
yeah.
I was kind of doing it on my own, and I built the support system and learned and created relationships afterwards. So I
Yeah.
kind of put the cart before the horse, but go ahead and do that now, right? Whether you're buying a property now, and ironically, there are a lot of deals that happen in those groups where people are doing deals with each other, right? They'll be in a meetup, they'll meet somebody, two, three, four people will end up doing a deal together, or they're in a mentorship group, and those people do deals together.
Yeah.
And some people never even leave that group as far as people they do deals with.
That's
Um, but
so.
it's also a support system.
Yeah.
It's like, man, I'm making this up, but um, I don't want to do an agency loan. I'm looking at a deal, but I want a fixed rate loan that's non-recourse. And
Mhm.
recourse means, do you have to do a personal guarantee on it or not? It's like, who do I call? Well, call some of the people that you've met in these groups. It's like, do you know anyone, or could you recommend anyone? Um, there are Facebook groups. Many of these groups will have their own Facebook group, and it's a collaboration, where you can drop questions out there and people will answer questions for you. But get plugged in, I guess, is a good way to say it, right? Find something or a group or an organization or team that works for you that you click with and get plugged in.
Yeah, and I can't speak highly enough of what you just mentioned, especially once again in our industry. Networking is so key. I mean, my personal life has changed just because of the relationships that I've built, and it's so crazy. Now looking back 2 years ago, it's so crazy how just who I know has completely changed the direction of my life and my future family's life and my
Yeah,
legacy.
yeah.
Really, it's absolutely insane. So I 100% agree with what William just said. Plug in. Just because the market is shaky right now doesn't mean that you can't still do things to get ahead of this market condition. So
Keep moving forward.
exactly, exactly. Last two questions here that I'm going to ask you, Will, is in the topic of networking and relationships. What is one thing or one person that will help you in your business right now in order to accomplish those goals that you have for yourself?
Interesting question, because I think it varies for everybody, right? And I mentioned to you, I'm in a different stage or season of life than other people are, and even people that are at my age, right? You know, we started our family later in life, and we got married later in life, and so many people my age that we associate with, those parents or kids are either in college or out of college, and I got a freshman in high school. So I'll probably be going down the wedding aisle in a walker. I don't know, but um, we all have different needs and requirements, right? But I think if you can do some self actualization and figure out where you are and give some serious thought to where you want to be, and figure out what that roadmap needs to look like, and then start filling in the blanks. You know, and that roadmap's going to be different for everybody.
Yeah, love that. Love that, man. Well, it's been. I've had a ton of fun. Being on this podcast with you. I would even call it a podcast. I would just call it a great conversation. And on that note, I'm sure a ton of people are going to want to, reach out to you. Maybe don't give your cell phone number. Where can people connect with you to, either, invest with you because they now see you as a well-proven operator, or just, connect with you to look at deals together? Where can people, connect with you?
Yeah, certainly. So I've got to you can hit my website, right? So the company name, and I'm actually going through a rebranding process. So over the next 6 months, it's probably going to shift. But today, and it'll probably be around for a long time, so you're not going to get orphaned. But today, it's GDD Invest, golf, dog. If you call me, I'll tell you where GDD comes from. It's a humorous story. But GDD Invest LLC is the business name, and so it's gddinvest.com. My email address is william.edwards@gddinvest.com.
Beautiful, beautiful. And I'll put uh, Will's information in the show notes for anybody that wants to connect with him. Again, wealth of knowledge, great resource, and a great person as you have gotten to know Will. He has a ton of experience and definitely a great individual to connect with, especially within the industry that we're all in. Will, once again, I've had an amazing time. Thank you so much.
Absolutely, man. This is fun.
Yeah, thank you so much for coming on. It's been Teeny Collin, William, Action Taker, Edwards signing off.
All right. Thank you.